Here we are in scenario one. We're taking a look at the base case in this situation. So we're just assuming that there's 100,000 in gross income from Schedule C, and that's also the net income as well, because there's really nothing else going on in this scenario. Now, looking at the tax return, we see that there's 100,000 in total income. That's all coming from Schedule 1, which shows it's all coming from Schedule C. Let's take a look at that for a quick second. And we see that there's gross receipts of 100,000, nothing else going on because, again, we're not placing any assets in service, no Section 179, what have you. And with all of that said, this also does take into account the QBI deduction. I am including that in this projection. And we come out to a total tax of $24,309. So let's just include that in here. All right, and we'll use that as the baseline for comparison as we look at scenarios 2 and 3. Now, taking a look at scenario number 2, we have a very similar situation, but now we have purchased and placed in service $50,000 in machinery and equipment, and we're also electing $50,000 in Section 179. So let's do that. We'll go to the depreciation section here. So the cost basis would be $50,000, and then the Section 179 deduction would also be $50,000. Let's make sure that we did that correctly. All right. Now, let's take a look back at Schedule C. Now, in this scenario, you see that there's still 100,000 in gross receipts. We're good there. But now you see that there's 50,000 in the depreciation and Section 179 expense deduction line 13. And what's happening is it's reducing the net income on Schedule C by 50,000. So that's also going to decrease on Schedule SE the amount that's subject to self-employment tax. So there's definitely some savings to be had there by taking the depreciation all in a single year. So let's take a look back at Form 1040. Now we have 50,000 coming through from Schedule 1 here, which is coming from Schedule C. All right. And overall, we see that the total tax decreased to $10,184. All right, so $10,184. All right, so quite a significant savings, right? We had $24,309. Now we have $10,184, and I'll do some calculations here to show you the actual differences in a second. But let's take a look at scenario 3 real quick. Now, in this scenario, we have the same gross income on Schedule C. We have the cost of equipment purchased and placed in service is $150. So let's adjust that. So again, it exceeds our gross income for the year. Now we're also taking Section 179. Okay, so we have 150,000 in Section 179. So let's take a look at the Form 1040. Wow, big difference. All right, so let's see what's going on here. So on Schedule C, we have 100,000 in gross receipts. Then you see here on line 13, now we have 100,000. That's taking the net income from the Schedule C business all the way down to zero. So of course, Schedule SE for us disappears here because there's nothing to calculate self-employment tax on. Let's just take a look at that. Okay, so there's nothing happening on Schedule SE. Let's go back to the 1040. And you can see here that essentially there's not much going on. Now let's take a look at the other page here that shows us the carry forward. All right, so here you see that there's Section 179 deduction that's being carried over to tax year 2019. Pretend this is going from 2019 to 2020, but same idea. Now, what that means is essentially that on Schedule C, what's going on is the limitation as far as business income is being applied to Section 179. So one of the drawbacks, if you will, of Section 179 is that you need to have sufficient business income to support the deduction. Your Section 179 deduction cannot create a loss. Okay, so if you have 100,000 in net income from the business, which is what we're assuming, the maximum Section 179 deduction you could take is going to be $100,000. Now, we are going to be taking a look at what happens when you have some wages and other earned income on the Form 1040. But again, I want to just keep it very simple and state that if you have 100,000 in net income from a business, you cannot create a loss by taking more than that amount in Section 179. It's just not allowed. So what happens is if you have excess Section 179, being that we took 150,000, but we only had 100,000 in net income, that extra 50,000 is carried forward to the next tax year when you have adequate net income from your business to take that deduction. So it's really important to keep in mind that if you have losses in a particular year, Section 179 is not going to help you because it can't exacerbate that loss or increase that loss. Similarly, if you have zero net income, Section 179 is not going to be applicable. And if you have a low amount of net income but a big Section 179 deduction, know that you're only going to be able to take that small portion of it, and then you'll carry forward the rest of it to future tax years. So that's what's going on in this scenario number 3 here. And obviously that decreases the amount of tax due to zero because there's really nothing happening on this tax return. There's a lot happening behind the scenes, but in terms of calculating tax, there's nothing there. We had $100,000 in net income from the business minus $100,000 Section 179. We zeroed it out. So that's why there's no tax liability there. So let's take a look back at our spreadsheet here. And one thing that I wanted to note is that there's definitely differences here in terms of tax liability to take into account. So let me just do this here. All right. Okay. So in terms of the differences, by purchasing and placing in service $50,000 in assets in scenario 2 here, based on our $100,000 in gross income from the business, we essentially save $14,125. So really, if you want to look at the net cost of assets, okay, one way to look at it is to say, okay, we placed in service $50,000 in assets, but we got a tax savings of $14,125. That brings the net purchase price, if you will, to $35,875. Now again, we're not taking into account time value of money. We're not looking at discounted cash flows or anything like that. Let's just keep it real simple and assume that just looking at this tax year in and of itself, it's a pretty significant savings there. And that's why there's such a motivation to use Section 179 and other similar provisions when it's available. So with that said, in scenario 3, you see that even taken to a larger extent there, because you can see here that we're bringing the tax liability to zero. Now, it doesn't quite work out like that in every scenario. Obviously, there might be situations where your net income is a lot higher and so forth, but in this particular case, you're saving $24,000 off of the purchase price of essentially $150,000 in assets, and in addition, you're still getting the carryover to the next year that you'll be able to use when you have more net income from the business. So there's a lot going on there, but that's why it's important to keep this all in mind to see if it's more advantageous for you to take Section 179 or wait for a subsequent tax year and space out the depreciation deductions. So with all that said, let's keep going. Now, scenario 4 and scenario 5, they're a little bit different because we're going to be taking a look at the effect of wages or other earned income on the Section 179 deduction. Because here's the thing. I mentioned that you're limited to your net income from the business in terms of your Section 179 deduction. But when you're on an individual return, Section 179 also allows you to include other earned income, such as wages, in determining your ceiling for Section 179. Now, I'm going to illustrate how that works in a second. By taking a look at scenario 4, it's very similar to scenario 3, but in this case, we just added $100,000 in wages, and let's see what that does to the overall situation. So let's take a look. All right, so taking a look at the wages, we're going to add $100,000 in wages here to the scenario. All right, and let's see what that does. So taking a look at scenario 4, we can see that the $100,000 is being taken into account as gross receipts on Schedule C, but on line 13, we have $150,000 in Section 179 deduction, which is kind of strange because we talked about the fact that the net income from your business is what determines your maximum Section 179. But in this case, on a personal tax return, since we now have wages, which is other earned income on the return, we're able to incorporate that along with the net income on Schedule C to determine our ceiling for the Section 179 deduction. So essentially it's saying, okay, if you're filing a Form 1040 with Schedule C and you have wages on top of the net income from the business, you can essentially combine those to maximize Section 179. And that's exactly what's happening here. So even though we have net income from the business essentially of $100,000, we are taking into account $150,000 in Section 179 because we have $100,000 in wages, which we have entered here. Now let's take a look at the Form 1040, see how that looks in scenario 4. We have the $100,000 in wages, then we have the total income coming from Schedule 1 of negative $50,000 because we're using the whole Section 179 deduction on Schedule C, which is bringing our net income on there to negative 50,000. All right, so moving along, we don't have a QBI deduction because there's a loss here, but I'm really not going to touch on QBI in this video. I've touched on it in a different video, so we'll leave that be for now. But you'll see the total amount of tax due is a $43.73, and that there's still some taxes due on the wages there. But essentially, it's important to take into account that if you have wages available on a personal tax return with Schedule C, you may be allowed to use more of that Section 179 deduction. And in this case, unlike Scenario 3, you're not carrying forward to the next tax year any of that 179 allowance. So it's an important dynamic to keep in mind there. And finally, let's take a look at Scenario 5 and see how that compares to Scenario 4. Now, I've altered it slightly just in the amount of the Section 179 deduction that's actually being taken. Now, you can see that even though we purchased and placed in service $150,000 in assets, we're only electing, because we can choose how much Section 179 we want to take, $100,000. All right? And you'll see here that there's MAKER's depreciation. MAKER stands for Modified Accelerated Cost Recovery System, which is your kind of vanilla depreciation if you aren't taking these accelerated methods into account. You'll see that there's a little bit of that going on. But what this is essentially coming out to is creating a small loss on Schedule C due to Section 179 instead of Scenario 4, which is a larger loss on Schedule C. And why would you want to minimize the loss on Schedule C? Well, keep this in mind. When we use Section 179 to decrease the income on just Schedule C alone, we're decreasing income tax and we're decreasing self-employment taxes, right? Because as we looked at the earlier scenarios, the amount that hits Schedule SE, where the self-employment tax is calculated, is decreased by Section 179. Now, if we have $100,000 in net income from the business and we take $100,000 Section 179, that's affecting that whole $100,000, both self-employment tax and income tax. So that's a good benefit right there. You're getting the double whammy, so to speak. Now, on the other hand, if we're using Section 179 as we did in Scenario 4 to offset wages, then the distinction is that we're lowering income taxes, but we're not lowering self-employment taxes. So it could be argued there that the benefit has decreased since we're offsetting earned income that's not on that Schedule C subject to self-employment tax. So that's an important dynamic. Obviously, it could get way more complex than this, but you could see the different factors that weigh into making the decision as to whether or not you want to take Section 179, how much of it you want to take, how you incorporate that along with bonus depreciation and MAKERs and all of that. But again, I'm trying to keep this as basic as possible and let you know that there are strategies and there's a thought process involved in using depreciation in your favor. So in Scenario 4, while it may seem like it's advantageous to write off as much Section 179 as possible, you may be better off waiting for subsequent tax years to depreciate the asset against self-employment income to reduce that as much as possible. So it's a matter of putting a projection together and seeing what works best for your particular business, because there are definite upsides and downsides to offsetting other earned income with Section 179. Now, in Scenario 5, you can see here that we're not taking the full deduction. We're only taking $100,000, and then there's some MAKER's depreciation being calculated on there as well of $5,000. So let's take a look at what that looks like. Now, in Scenario 5, we're assuming that there's $100,000 in wages, $100,000 in Schedule C gross income, and $150,000 in assets purchased and placed in service in that year. But keep in mind that we're only electing $100,000 in Section 179 in the year, and there's also going to be some MAKER's depreciation calculated of $5,000. We're assuming straight line for this example. I know you can accelerate MAKERs, but in this scenario, let's just assume straight line. And we get $105,000 of total Section 179 and depreciation included along with it. So let's take a look at what the tax liabilities are when we compare the two. Now, taking a look at Scenario 4, where we purchased and placed in service $150,000 and elected to take the full $150,000, the total federal income tax due would be $43.73. Okay. Now let's take a look at Scenario 5 and compare. We're only electing $100,000 in Section 179 in this case. All right. So in this case, the tax jumps to $14,216. Now let's take a look at that a little bit more closely here. All right, so the difference there is pretty significant. All right, so by taking a smaller portion of Section 179, obviously that's increasing the amount of tax due by almost $9,500. But at the same time, we also have to consider that there's more depreciation that will be available in future tax years to offset against self-employment income, because whatever you don't take in Section 179, you can deduct later using makers and so forth. So there is still the ability to use that depreciation over time if you have a business justification to do so and if it makes sense for you. But it's important to take into account that taking as much Section 179 in a particular year may not be the most advantageous way to go in every situation. So that's why I put together these multiple scenarios here so you can see how this plays out on the actual tax return with different iterations being put into play. Now, obviously, this can get much more in-depth because there's not only Section 179, there's bonus depreciation, there's other provisions that allow you to write off assets that you placed in service, and this can get extremely complicated. I mean, people fight like cats and dogs over this stuff with regard to what Congress does and how much depreciation is available and whatnot, because this could mean millions or billions of dollars in tax savings if you can write off certain amounts of assets in a particular year. So this can get much more complex than what we're looking at right now, but the idea here was to really shed some light on what 179 is all about and different iterations and things to consider when you're actually putting it to use. Now, one serious consideration to keep in mind with regard to Section 179 is recapture. And what that means is that in the 5-year period after an asset is purchased and placed in service, if the amount of business use drops below 50% for that asset, then you are going to include in income all of the Section 179 that you took for that asset in the previous tax years up until that point. So, a lot of taxpayers have that laptop that they use, 51% for business, right? You've all had that laptop? Yeah, listen, I know, I see your tax returns. So you have to be really careful with Section 179 in that regard, because if that laptop goes in the next tax year from 51% business use to 49% business use, then guess what? You may be subject to recapture. And then there's some other reasons that can trigger recapture as well. So it's not that you can purchase assets for your business in year one, take Section 179, and then convert everything to personal use. Okay, Congress frowns upon that. They don't like that. Definitely don't do that, because the recapture will end up on your tax return. Essentially, you'll lose all of the benefits that you gained by taking Section 179 in the first place. So that was a brief overview of Section 179. Hopefully this video was helpful in shedding some light on the provision and also in giving you some ideas on how you may be able to incorporate it for your business moving forward. Now, with that said, if you enjoyed the video, feel free to like and subscribe and hit that bell icon to be notified of future videos as soon as they're released. And also, feel free to leave a comment. I love reading your comments. Hopefully this was helpful. Thanks for watching. Giving you some ideas on how you may be able to I'm gonna get it.